Hi, everybody. Welcome back to Ox Talks. I appreciate you watching the show. Thanks for supporting the channel. Thank you for liking these videos, hitting the thumbs up. Share these videos with people as far and wide as you can. And please hit that subscribe button. It does mean a lot to me. We're growing the channel. Yesterday, I did a show discussing the state, if you will, of the residential real estate market in this country. And we talked about existing home sales and new home sales. This show, I want to talk to you about commercial real estate. And commercial real estate is a pretty broad spectrum: office buildings, malls, all those kinds of things, multifamily, if it's over a certain number of units. So I want to address the state of the commercial real estate issue and then share with you an article I saw that really plays into that, about how these banks are really masking and hiding the true situation with the status of these commercial loans. And this affects all of us. You guys might think, well, I'm not into commercial real estate. It doesn't pertain to us, but it does. And I'll tell you why. Because the smaller and mid-sized banks are levered up, highly levered up with commercial loans that they have made, okay? So this relates, and this will hit home, certainly in smaller communities sometimes, when these things start, will eventually start defaulting. So let me jump right into, it's two articles I'll share with you, same concept. The first one's out of Global Street today. It says CRE, commercial real estate, mortgage delinquencies climb as office struggles persist. It says delinquencies for commercial real estate mortgages climbed in the third quarter of 2024, but not all sectors felt the same pain. Loans backed by office and multifamily properties saw upticks in late payments, while delinquency rates for retail, industrial, and hotel properties fell, according to the Mortgage Bankers Association's latest loan performance survey. Overall, it says 96.8% of outstanding loan balances were current or less than 30 days late at the end of quarter three, and that's down slightly from 97% in the previous quarter. Okay, so it is falling. What's falling is the number of loans that are delinquent. The percentage of commercial mortgages classified as delinquent for more than 90 days or in real estate owned REO status increased by 20 basis points to 2.7%. You guys might think that's not a big deal. That's a big deal, okay? And those are loans that are now delinquent more than 90 days. Some of these loans are multi-million dollar loans. Again, leave your comment below when they get 90 days delinquent, just like somebody with a credit card debt or an auto loan debt. When they get 90 days delinquent, it's not coming back. It's not coming back, because they're going to end up defaulting, going back to the bank, or there'll have to be some kind of a rescue plan put in place. Or, like the next article I'll share with you, we extend and pretend. It says, and again, that should be 2.7%, 20 basis points is a real problem, should be a major red flag. Some property owners are facing increasing challenges, it says, with their mortgage payments, said Jamie Woodwell, MBA's head of commercial real estate research. Loan performance is being impacted by a variety of factors, some positive and some negative, depending on the property type and the market. Says office properties continue to feel the strain, with delinquencies on loans tied to these assets rising 70 basis points to 7.8% by the end of September. Okay, that is massive. The office sector's troubles have been exacerbated by remote work trends, causing a glut of unused space post-pandemic, forcing many owners to renegotiate leases or face mounting financial pressures. It says multifamily loans also saw a slight uptick in delinquencies, rising from 1.1% in quarter two to 1.2% in quarter three, reflecting ongoing challenges in the rental market despite strong demand in some regions. So on the flip side, lodging, retail, and industrial properties appear to be faring better. Delinquency rates for the retail loans fell 70 basis points to 3.8%, and industrial properties recorded just a 0.6% of loan balances in delinquency at the end of the quarter. The hospitality sector also saw improvements as travel demand continued to recover, it says, with hotel loan delinquencies dropping by 30 basis points to 5.7%. The growing divide, it says, between office and other sectors underscores the uneven recovery in commercial real estate. As office landlords struggle with shrinking demand, retail and industrial spaces are seeing stronger performance driven by shifting consumer habits and e-commerce growth. It says while rising delinquencies could be an early sign of economic stress, particularly in the office sector, the overall market remains relatively stable, and it says for now. Key words, for now. Lenders may adopt more cautious strategies, tightening underwriting standards, and potentially raising interest rates on new loans as the landscape evolves. It's interesting they say that lenders will consider raising rates in order to try to offset risk, okay? And I'm going to share the next article with you from Reuters, and this addresses the fact, and please stay with me to the end, because what they're saying is the only way that the banks are going to be able to avoid this nightmare is by lowering rates substantially, right? If the Fed lowers the rates, which will help rescue these defaulted loans. So something is inconsistent, right? They can't both unfold simultaneously, right? It says this is titled New York Fed says banks are obscuring commercial real estate risks by extending loan terms. And listen to this stuff. It says New York Fed warns stressed banks obscuring commercial real estate issues. New York Fed, troubled banks extending commercial real estate terms. A New York Fed extended troubled CRE loans could quickly become a broader problem. Banks have been tweaking the terms of commercial real estate mortgages to obscure, means hide, losses, and in delaying the day of reckoning, are increasing risks to the broader financial system, a paper released Wednesday by the Federal Reserve Bank of New York said. The commercial real estate sector, or CRE, has been under heavy pressure from the pandemic and its aftershocks. Lockdowns and widespread rise of remote working has reduced the need for office buildings and similar structures. As is thus far, the sector has shown no signs or few signs of recovery. On top of that, aggressive Fed rate rises between the spring of 22 and July of 23 further pressured the banks. It says banks extended and pretended their impaired CRE mortgages in the post-pandemic period to avoid writing off their capital, leading to credit misallocation and buildup of financial fragility. Okay, so let me repeat that. They have extended and pretended their impaired mortgages. They're hiding this stuff on the books to avoid writing off their capital, to avoid leading to credit misallocation and a buildup of financial fragility. The study's authors wrote, adding problems associated with this lending could arise quickly. Fed officials have been bracing for some level of manageable trouble, it says, that do CRE loans, but have broadly argued that whatever issues arise will likely be modest, concentrated in smaller banks and slow-moving as financial institutions navigate the troubled landscape. Again, leave your comments below. How many mid-size and smaller banks are going to get hit by this? We know that there's a movement towards consolidation. All right, you guys can research that yourself. There's no doubt what the end game is, right? To fold some of these smaller and mid-size operations into the larger banks, give the larger banks more power, more control, more influence. So when this starts kicking off, when these 90-day lates and delinquencies become 120 days, become totally non-performing, and they can't extend and pretend anymore, then what happens? So then yet, as bad as the pressure has been on the sector, the issue thus far has failed to generate broader dislocations. And that's because they're lying about it, right? The report noted non-performing loans and net charge-off have remained low, or charge-offs have remained low by historical standards, especially for weakly capitalized banks. The paper notes that CRE mortgages are mainly issued and held by banks, with these firms accounting for 50.7% of the $5.8 trillion CRE loan sector. $5.8 trillion. Even if, 20% of that becomes non-performing and goes belly up, that's going to be a massive impact to the financials sector. It says banks with weaker mark-to-market capital levels tied to losses in their securities holdings are the primary vector for the CRE mortgage extensions. The firms have, since the first quarter of 2022, pretended that such credit provision was not a distressed, it was not distressed or as distressed to avoid further depleting their capital. They just extend the loan terms, right? They don't call the loans due. They just work with the borrowers to keep it showing on their books as a performing loan. Extending the maturity of these troubled loans has made it harder to make new CRE loans and has increased the chances that troubled CRE mortgages will face an imminent reckoning. Noting the maturity extensions granted by banks also fueled the volume of CRE mortgages set to mature in the near term. A maturity wall, it says, with the associated risk of large losses materializing in a very short period of time. I mean, it can't make it any clearer than that, okay? We have a maturity wall, okay, which is going to be hit soon. The paper said CRE mortgages from weakly capitalized banks have 0.2 percentage points higher probability of getting the terms extended versus better capitalized banks. It says the Fed rate cuts that kicked off in September are projected to continue, could, however, bring some relief. Here we go. On Monday, Moody's lifted its outlook on the banking sector to stable from negative, in part because stabilizing asset quality for banks due to rate cuts, especially for CRE loans. So that's all, again, that's all banking on the fact the Fed is going to continue slashing rates. But let me pose this question. Love to get your feedback and your comments. At what percentage rates are most of these commercial loans? I'll guarantee, again, I don't know, okay, but I would bet that those loans are sub 5%, okay, maybe even sub 4%. So at what point does the Fed have to how much does the Fed have to cut rates to get these loans into a position where somebody could refi and not feel the sting, right? Otherwise, at some point when this wall gets hit, the maturity wall, these properties are going to go back to the bank, or the owners have to find a way to refinance the properties into whatever the then rate is, all right? So you guys, again, leave your comments below. This affects all of us because it's going to affect lending standards, not just for commercial real estate. It's going to impact these small and mid-sized banks probably disproportionately. I'm going a little bit long here today, a little ranting, but I see this stuff. And again, it's always sweep it under the rug until you can't do that anymore, and then say, well, we told you, we put breadcrumbs out letting you know this was going to be a problem, that it was fragile, that it could be lead to a lot of contagion in the system. And so we have to be paying attention to this stuff, okay, on a broader spectrum. I'll leave it there today. We're a little bit long. Again, I appreciate all of you watching, sharing the videos, and subscribing. I'll talk to all of you soon. Bye.